Ever wondered how you can start investing with just $100? For many, the world of investing seems like a far-off land, accessible only to those with stacks of cash. It's a common misconception that you need to be wealthy to start, but that's far from the truth. In reality, you can embark on your investment journey with as little as $100. Yes, you heard it right. Just a single $100 bill. Investing isn't a game reserved for the rich and famous. It's a financial strategy that anyone can take advantage of, regardless of their starting point. It's about making your money work for you, instead of the other way around. So forget the myth that you need a fortune to start investing. Today, we're going to dive into how you can start your journey towards financial prosperity with just $100 in your pocket. Believe it or not, the journey to financial prosperity can start with just a $100 bill. Before diving into the investment world, it's crucial to grasp some basic concepts. Think of investing as planting seeds today to reap fruits tomorrow. The seeds are your money, and the fruits are the potential returns your investments can generate over time. Let's start with stocks. When you buy a stock, you're essentially buying a tiny piece of a company. If the company does well, the value of your stocks goes up. However, if the company's performance dwindles, your stocks may lose value. Bonds, on the other hand, are somewhat like loans you give to a company or the government. In return, they promise to pay you back with interest after a certain period. Then we have mutual funds. These are investment vehicles that pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. They're managed by professional fund managers who decide where to invest the pooled money. Exchange-traded funds, or ETFs, are similar to mutual funds, but can be bought and sold throughout the day, like stocks. They often track an index, like the S&P 500, so when you buy an ETF, you're essentially investing in all the companies in that index. Finally, let's talk about diversification. It's the practice of spreading your investments across various assets to minimize risk. Think of it as not putting all your eggs in one basket. Even with just $100, you can diversify your investments. You could buy a fractional share of a stock, invest in a bond, or put your money in a low-cost ETF or mutual fund. That way, if one investment doesn't perform well, others may offset the loss. Remember, investing isn't about getting rich quick. It's about growing your wealth steadily over time. It may seem intimidating at first, but once you understand these basics, you're setting yourself up for success. With the basics in hand, you're already on your way to becoming an investor. Now that you have the basics down, the next step is to find the right platform for your investments. The world of investing can be a labyrinth if you don't know where to start. And that's why choosing the right platform is absolutely crucial. Think of it as the foundation for your financial house. If you select a platform that doesn't suit your needs, it's like trying to build a skyscraper on quicksand. So, how do you pick the right one? Well, it all depends on your individual needs and circumstances. Some people may prefer a hands-on approach, while others might want a more automated process. You might be asking, what options are out there? Well, let's delve into that. First, we have low-cost online brokerages. These platforms are designed for the do-it-yourself investors who want to be in control of their own portfolios. They offer a range of investment options from stocks and bonds to mutual funds and ETFs. The best part? They often come with lower fees than traditional brokerages. Then, there are robo-advisors. These are digital platforms that provide automated, algorithm-driven financial planning services with little to no human supervision. A typical robo-advisor collects information from clients about their financial situation and future goals through an online survey, and then uses the data to offer advice and automatically invest client assets. Finally, we have investing apps. These platforms are perfect for those who want to start small. Many of these apps allow you to invest with as little as a few dollars, and they make investing as easy as clicking a button. It's important to remember that each platform comes with its own set of pros and cons, and what works best for one person might not work for another. So take some time to research and find a platform that aligns with your investing style, financial goals, and comfort level. Finding the right platform is just as important as deciding what to invest in. So choose wisely and remember, every great investment journey starts with a single step. You're equipped with the basics and have chosen your platform. It's time to make your first investment. Now, investing can seem daunting at first, but don't worry. We'll walk through the process together. Let's start with stocks. Think of buying stocks as buying a piece of a company. When you purchase a stock, you essentially become a part owner of that company. You can buy stocks directly from the company itself or through a brokerage firm. Bonds, on the other hand, are a form of loan. When you buy a bond, you're lending your money to the issuer for a certain period, and in return, they promise to pay you back with interest. Bonds can be issued by corporations, municipalities, and even the federal government. Exchange-traded funds, or ETFs as they're commonly known, are a type of investment fund and exchange-traded product. They're designed to track the performance of a specific index, sector, commodity, or asset. When you buy shares of an ETF, you're buying a piece of a portfolio that mirrors a specific market index. Once you've decided what to invest in, the next step is to actually make the purchase. This is where your chosen platform comes into play. Simply log in, navigate to the trading page, search for your chosen stock, bond, or ETF, and click Buy. It's as easy as online shopping. Now let's talk about dollar cost averaging. This is a strategy where you invest a fixed amount in a particular investment at regular intervals, regardless of its price. The idea is to spread out your investment over time to reduce the impact of market volatility. For example, instead of investing your entire $100 at once, you might choose to invest $20 every week for 5 weeks. Remember, investing is not about making quick cash, it's about growing your wealth over time. So stay patient, stay informed, and keep investing. Congratulations, you've just made your first investment. Investing isn't a set-it-and-forget-it kind of deal. It requires regular monitoring and adjustments. Now that you've made your first investment, it's important to understand that this is just the beginning. The world of investing is dynamic, and your investments need to be able to roll with the punches. Think of it like a garden that needs regular tending to thrive. First off, make a habit of regularly reviewing your investments. This doesn't mean you need to watch the stock market every minute of the day. In fact, that's a surefire way to stress yourself out. Instead, set a schedule. Maybe it's once a week or once a month. During this time, take a look at how your investments are performing. Are they growing as expected? Are there any unexpected dips or surges? Next, consider your financial goals. Have they changed since you first started investing? Maybe you were initially saving for a down payment on a house, but now you're thinking about starting a business. Or perhaps your timeline has shifted, and you want to retire earlier than expected. Changes in your financial goals should prompt a re-evaluation of your investment strategy. And let's not forget about the performance of your investments. If one of your investments isn't performing as well as you'd hoped, it might be time to make some adjustments. Maybe you need to diversify your portfolio, or maybe you need to switch to a different type of investment. Remember, it's okay to make changes. What's important is that you're making informed decisions based on your financial goals and the performance of your investments. Lastly, don't be afraid to seek advice. Whether it's from a financial advisor, a trusted friend who's savvy with investments, or an online community of investors, getting a second opinion can be incredibly valuable. Remember, investing is a marathon, not a sprint. Patience and consistency are key. Even if you're not seeing immediate results, keep in mind that the most successful investors are those who play the long game. Adjusting your investments isn't about chasing quick wins, but about ensuring your financial growth over time. So you've taken the first steps towards becoming an investor. Let's quickly recap what we've covered. We started by opening the world of investing, unveiling the potential that your $100 hold. We then dove into the basics, making sure you understand the fundamental principles of investing. It's all about making informed decisions, isn't it? Next, we explored various platforms, stressing the importance of finding one that suits your needs and comfort level. Then came the exciting part, making your first investment. We walked through how to take that initial plunge, transforming your $100 into a growth potential. Lastly, we emphasized the significance of monitoring and adjusting your investments. It's a continuous process of learning, adapting, and improving. And just like that, you're on your way to making your money work for you. Remember,